China, Japan, South Korea, and the Asian nations issued a joint statement promoting trade in local currencies, reducing dollar dependence, and pushing back against U.S.-driven protectionism. Now, these were countries that were rival powers that are now aligning economically, signaling, I guess, a new era. This is something that we've never seen before, where these countries who were once rivals are now coming together. That's a big deal, right? So they made that announcement. But remember, let's go back a couple of weeks ago when we talk about the announcement that China and their new cross-border payment system, the RMB cross-border settlement system, they connected it to those same 10 Asian nations, or the countries in Southeast Asia, and 6 Middle Eastern nations, covering 38% of global trade. And this cross-border payment system settles in 7 seconds instead of the 3 to 5 days that this is mBridge, and it settles in 3 to 5 seconds instead of the 7 seconds instead of the 3 to 5 days that SWIFT takes. So you've got all of these countries aligning together in trade, in settlement. They're all the ones that have been buying gold. Now let's take it a step further, right? So you have them all coming together and making a joint statement. You have the Russian finance minister saying that this technology will be opened up to non-BRIC nations. That's the biggest thing ever. So you're talking about the Belt Road, which is 70% of human population already, the Shanghai Cooperation Organization, the Eurasian Economic Union, the Asian countries who are now signing a joint agreement together, used to be adversaries and now are uniting. And then you look at the announcement that the Shanghai Metals Exchange just made, and that they are going to be internationalizing the exchange by opening up depositories in Hong Kong, in Saudi Arabia, and in other parts of the world to internationalize their yuan settlement. So they will be able to buy oil, as an example, from Saudi Arabia, pay for it in yuan, and settle any imbalances in gold. And all of it will be done outside the purview of the SWIFT. Now, they can do the same thing with countries that have no ties whatsoever to the BRICS across the entire Belt Road. These things are happening right underneath our nose, and nobody is talking about. But if you look at the linear progression of it, where first they connect on this bridge technology, then they make a joint statement, a united joint statement, which is huge. Then they say, well, we're going to open this up to non-BRICS nations, and now they're building gold hubs all around the world in order to settle the imbalances. This is happening, and you can see the world is preparing for a new monetary system that's going to be tied to gold. I believe that in my soul. I do. Since in March alone, China added 5 tons of gold, and that's 5 consecutive months of purchases. But Goldman Sachs says that those numbers are 10 times understated. We know all of that. But then we look at what's happened on COMEX, right? Since this Easter, we've seen 11,692 silver contracts in one day stand for delivery. That's 1,993 tons. Take 11,692 multiplied times 5,000. That's how many ounces stood for delivery in one day. Since Easter, we've seen 34.5 tons of gold stand for delivery. These numbers are off the charts. And so something big is happening. Something really, really big is happening that I don't think most people, even those that are following this kind of stuff, really are grasping, because the BRICS information kind of shut off in January, and that's because of what happened with the BIS and mBridge. But they are progressing in a way that I think is accelerating and opening it up to countries that are not on the BRICS 11. You just saw Indonesia become the 11th member. They have the largest deposit of nickel in the world, and growing. 40-some countries have signed up, Vietnam being the last So you have the meeting coming up here in July, which coincides with the Basel III reclassification of gold, amongst other things, the banking regulations that go into effect in July. There's a lot of stuff happening, man, a lot. And I think over the next couple of months, things are going to get nuts. We see gold fall by $200 last week, and we're told that it was the Chinese selling, yet the Chinese markets were closed. So how the hell does that happen? And it wasn't selling physical gold, it was selling futures on the Shanghai Exchange. Maybe those orders were put in prior to the weekend, right at the close. And it doesn't have to have been Chinese traders. It could have been American traders trying to hammer down the price. And then you see what happens. The minute China opens back up, we're up $200 in a day. Now, you know, nothing signals a hot war potentially between two nuclear powers in Pakistan and India as a $40 dump in gold. But what is $40 anymore? $48. That's just over 1.25%. The numbers, as the price goes higher, those percentages become less and less and less. A $100 move is only 3%. And I think you'll begin to see $100 and $200 moves in gold on a regular, this will be regular, you know, all the time. I think you'll start to see big moves in silver as well. And then we talk about what gold represents, right? Gold represents, to me, wealth, free from counterparty risk. And then you see what has happened over the last 2 days, right? The Treasury. We were supposed to believe that treasuries are what the rest of the world buys because we have the most liquid and trustworthy market. Gold now makes up almost 20% of global reserves, a 26-year high, while Treasury holdings are at their 22-year lows. But 2 days ago, we saw a branch of the government. So they quietly stepped in and bought $20.4 billion in 3-year Treasury notes. And then yesterday bought 10 plus billion, 14 billion in 10-year notes. So what does that tell you? That tells me that the market couldn't absorb the debt. It means private demand is drying up. It means the Fed had to stop in and be the buyer of last resort. It means confidence in the U.S. debt is wavering. The fact that they had to buy that much debt signals that the foreign and institutional appetite for treasuries is falling apart. More Fed buying, more dollars in circulation. That means more inflation, especially as the Fed keeps intervening behind the scenes. The 3-year and the 10-year it signals that the Fed is trying to suppress midterm rates, which is something they're not really supposed to do. Likely to ease borrowing cost. To me, Mark, this is what the fiscal endgame looks like. The government issues debt, the Fed buys it, and the illusion of this functioning bond market continues. But this is massive because the rest of the world says, I don't fucking want your treasuries anymore. Look at what you're doing. You're sanctioning, you're threatening, you're putting tariffs on, which aren't really tariffs, they're sanctions. I'm going to buy gold instead, which is in July in the United States becomes equivalent to a tier 1 asset with no counterparty risk, which is outperforming the treasury market. And no matter how hard they try to knock it down, it comes right back up. That volatility is what keeps everyone else out of the market. Oh, it's too volatile for me, but yet it keeps inching higher. Regardless, people said, oh, it's over, sell your gold. And then it goes up $200 again. So this is something that you're going to see continue, I believe, in a very, very strong way. You're going to start to see things accelerate as we get closer to July. The Bank of India just noted that they doubled their share of gold in its foreign reserves since 2021. India is increasing its gold reserves as well. Alan Greenspan said once, gold is a currency, no fiat currency, including the dollar, can match it. And I think that's the belief that, in my mind, you're seeing central banks live by right now, instead of any other currency, instead of any other instrument of savings like U.S. treasuries. This is changing. Gold is the barometer by which we measure the value and the health of the currency. Is it that gold is going higher, or they're destroying continually the value of the dollar? And that's the part that people have to understand. And watching the Fed come in and in essence buy $35 billion worth of treasuries when they are supposedly quantitatively tightening or moving away from that, adding to their balance sheet again. And when they buy those treasuries, it pushes interest rates down, which then incentivizes more of the nonsense that we've gotten ourselves into for the last 25 years. When you suppress interest rates, see, interest rates are supposed to be controlled by the market, not by a central authority. And when you suppress interest rates, you create distortions in asset prices, misallocations of resources and capital. You incentivize indebtedness. You incentivize countries to buy or companies to grow their company, to expand, to take on more debt, to build another wing, to hire more people. You incentivize people to take on more debt, buy a bigger house, buy a bigger car, do all of these things that you would otherwise not do. And because you expect easy money to be here forever. And at the same time, it's adding more and more and more inflation into the system that's not going away. Powell talked about eliminating his dual mandate, that he probably can't do both, and that is full employment and stable prices. In other words, what he's saying is that if we don't continue to lower rates and to let inflation run wild, the economy will contract massively. You'll see mass layoffs, you'll see corporates fail, you'll see stock prices tumble, interest rates rise. But that's the same thing that we see with the tariffs. I mean, let's not forget, what are the tariffs doing? And I see this accentuating and accelerating. We're in that acceleration phase right now